In this chapter, we will cover the two roles of an economist, the nature of economic models, and how to use the circular flow diagram and the production possibilities frontier. We will also distinguish between microeconomics and macroeconomics, as well as positive and normative statements. Economists act as both scientists who seek to explain how the world works, and as policy advisors who suggest ways to improve it. As scientists, they employ the scientific method, developing and testing theories based on data. The scientific method in economics involves observation, theory development, and rigorous testing. Because controlled laboratory experiments are rarely possible, economists often rely on natural experiments offered by historical events to analyze data and refine their theories. Economists build models to simplify complex real-world interactions. These models rely on assumptions to focus on essential factors, helping us understand the economy better. Remember, all models are subject to revision as new data and insights emerge. The circular flow diagram is a visual model showing how dollars circulate through an economy between households and firms. It simplifies the economy by focusing on two types of decision makers and two specific markets: goods and services, and factors of production. In the circular flow, households own and sell factors of production while buying goods and services. Meanwhile, firms hire those factors of production to produce and sell goods and services back to households. The two markets are the markets for goods and services, where firms are the sellers and households are the buyers, and the markets for factors of production, where households are the sellers and firms are the buyers. When we connect these flows, we see how money moves as income and spending. Firms receive revenue from sales, which then flows back to households as wages, rent, and profit in exchange for the factors of production. Another crucial model is the Production Possibilities Frontier, or PPF. This graph displays the various combinations of output an economy can produce, given its available resources and production technology. Consider a country that produces only airplanes and soybeans. Assuming fixed resources and technology, the economy can choose to produce only soybeans, only airplanes, or various combinations of both. Here are different production combinations. To increase airplane production from 0 to 20, the economy must give up 1,000 tons of soybeans. This trade-off illustrates the concept of opportunity cost. Plotting these combinations gives us the PPF. Points on the curve are efficient, meaning resources are fully utilized. Points inside the curve are inefficient, while points outside the curve are not feasible with current resources. Let's test our understanding. Looking at our previous graph, would it be possible for this economy to produce 80 airplanes and 4,000 tons of soybeans? Or 30 airplanes and 2,500 tons of soybeans? The results are clear. Point F is outside the frontier, making it not feasible. Point G is inside the frontier, meaning it is possible but inefficient, as the economy could produce more with its existing resources. Moving on to our summary of the PPF. Points on the frontier are efficient because all resources are fully utilized. Points inside the curve are possible but inefficient, and points outside the frontier are not currently achievable. When we move along the PPF, we shift resources from one good to the other, highlighting the trade-off society faces. The slope of the PPF at any point represents the opportunity cost of one good in terms of the other. Let's look at an example. If producing the first 1,000 tons of soybeans requires giving up 20 airplanes, the opportunity cost of one airplane is 50 tons of soybeans, while the cost of 1 ton of soybeans is 0.02 airplanes. Over time, economic growth can shift the PPF outward. This allows the economy to produce more of both soybeans and airplanes, or any combination on the new, expanded frontier, thanks to additional resources or improved technology. The shape of the PPF tells a story. A straight-line PPF implies a constant opportunity cost, while a bowed outward PPF indicates an increasing opportunity cost, meaning more must be sacrificed as production of a good expands. Why is the PPF often bowed outward? Imagine shifting resources from beer to mountain bikes. As we produce more bikes, the PPF becomes steeper, meaning the opportunity cost of producing additional mountain bikes increases. This happens because resources aren't equally suited for all tasks. At point A, we use everyone for beer production, including those better at building bikes. At point B, shifting the best brewers to bike production causes a large drop in beer output. Essentially, the PPF is bowed outward because different resources, like workers or land, have different skills and suitability for production, leading to varying opportunity costs across different output combinations. Economics is broadly divided into two fields: Microeconomics studies how individual households and firms make decisions and interact in markets. Macroeconomics, meanwhile, focuses on economy-wide phenomena like inflation, unemployment, and long-term growth. Economists wear two hats. As scientists, they use positive statements to explain the world as it is. As policy advisors, they use normative statements, which involve value judgments to suggest how the world should be. To distinguish the two, remember that positive statements are descriptive and testable with evidence, while normative statements are prescriptive and reflect personal values, often containing the word should. Let's test your knowledge. Which of these statements are positive, and which are normative? Consider if they describe how the world is, or how it ought to be. The first and last statements are positive, because they describe relationships we can test. The second and third are normative, because they express value judgments about what the government should do. In Washington, economists play vital advisory roles. The Council of Economic Advisors supports the president, while others in the Office of Management and Budget and the Department of the Treasury help shape spending, regulation, and tax policies. Beyond the executive branch, economists contribute to labor market policy at the Department of Labor, enforce antitrust laws at the Department of Justice, advise Congress through the CBO, and set monetary policy at the Federal Reserve. While economists advise the president, their counsel is only one piece of a complex puzzle. Presidents must also balance advice from communication, press, legislative, and political experts before making final policy decisions. Why do economists sometimes disagree? It often stems from differing scientific judgments regarding the validity of theories, or varying normative values about what a policy should aim to achieve. However, there is actually broad consensus on many issues. Consider the issue of ticket resale. Economists often analyze whether laws limiting this practice make audience members better or worse off. Such topics invite us to consider efficiency and the impact of price controls. Differences in opinion among economists also arise from varying scientific judgments about theory validity or the size of parameters. Beyond science, differing personal values or political philosophies play a significant role in their perspectives. There is strong agreement among most economists on several key propositions. For example, high majorities agree that rent ceilings reduce housing quality and quantity, and that tariffs and import quotas generally reduce economic welfare. Economists also largely agree on other matters, such as the preference for cash payments over in-kind transfers, the adverse effects of large federal budget deficits, and the impact of the minimum wage on youth unemployment. Imagine watching a debate on free trade with two economists taking opposing views. Your roommate might wonder how the average person can decide who is right if the experts themselves cannot agree. To address this, consider if their disagreement comes from different values or scientific models. If 93% of economists agree on an issue, it suggests that professional consensus is much higher than a televised debate might imply. In summary, economists are scientists who use models like the circular flow diagram and the production possibilities frontier. They distinguish between microeconomics, the study of individual decisions, and macroeconomics, the study of the economy as a whole. Finally, remember that positive statements describe the world as it is, while normative statements describe how it ought to be. When economists agree, policymakers may still weigh other political factors before deciding on a path.